recorded if you'd like to get a copy of it. We'll try to have it up on YouTube sometime later on this afternoon. And just want to confirm my audio is okay. Just send me a text and just make sure the audio is okay. I got another message from GoToMeeting this just saying that our audio may be compromised. So for those of you that are joining us, thanks for being with us this afternoon. My name is Charlie Castro. If you don't know me, I'm a host of a radio show called Real Estate 360. That's carried on the Wall Street Radio Network. I'll be moving actually to do Blog Talk Radio sometime in December, so be looking out for that. Many of you know me, some of you don't. We've been doing these since 2009, right after the market sort of crashed. We started doing these for a variety of different financial institutions and people like Entrust, Active Plan, those types of folks. So we've done several hundred of these webinars over the years. So I want to thank you for being on. If you want to ask questions today, we will take questions at the end of the webinar. So if you look to the right of your screen, there's a dashboard there. There's a little thing down below that says questions. If you click on that, a little panel will pop up. You just click on that, and you can ask your questions there. And you can ask your questions anytime during the webinar. Just feel free to ask a question anytime. I'll answer those all at the end. My special guest today is Brian Kaufman. He's the founder of Diverse Property Management in Jacksonville, Florida. We've got some exciting things to talk about, so with that, let's get right into the PowerPoint. This is our website, and all the properties that we'll be featuring today will be loaded up into the website sometime tonight. That's at buyrightproperties.net. And there is some other inventory in there. We do work other markets as well. And we also do work the Freddie Mac tape. So if you're looking for Freddie Mac type inventory, we can help you out with that as well. For those that have been seeing my advertisements for the last week or 10 days, I've spent some time in discussing the fact that I really felt that this was a unique opportunity, a unique webinar for us. We have profiled many people on these webinars over the years, different REO, specialized REO groups that were offering, turnkey real estate. This one was really unique. We sort of entered the Jacksonville market over the last 3 or 4 months, and we did that because there was a lot of hedge fund buyers going into that market. In our travels, we met Brian Kaufman, the founder of Diverse Property Management. And in the conversations, what we learned was that Brian was doing something completely unique from anything we've seen in the market before. And so we're going to be highlighting that today. And so just some of the things we're going to be covering today that is really, truly unique. I just wanted to set the stage right up front for what we're going to be talking about. But, double-digit returns on turnkey properties that you can fit into an existing portfolio or your self-directed IRA is not new or novel. We understand that. But the way that Brian and Diverse does it is very unique. I've never seen a property management team do the things that these guys do to maximize potential. One thing that they do, which is extremely unique, is they're going to escrow. If you buy X amount of properties from them, they're going to escrow the first year's net operating income at closing. So if the net income, and I'll give you some examples later in the slideshow, but for example, if you're going to, if the net operating income on a property is, $6,000, that $6,000 goes into escrow when you close that you can draw down from for the next 12 months. That's extreme. I've never seen anybody put their reputation and their ability to perform on the line more than what Diverse does in this particular offering. We're going to talk about something called cost segregation. Some of you may know what that is. Many of you probably won't know what that is. But we're going to talk about that and how it can benefit you in terms of your bottom line, and how Diverse Property Management utilize that strategy to help you improve your bottom line. We're also going to talk about how you can take full advantage of tax benefits. Now, disclaimer right up front, I'm not a tax preparer. I'm not an accountant. I would always encourage you folks to, talk to your tax professional when it comes to tax advice. But we're going to talk about some things that you may consider taking advantage of, which are the tax benefits. We're also going to talk about something called cost controls, another thing that's completely unique to what Diverse Property Management is doing in the Jacksonville market. It's something that we've just learned really in the last couple of weeks, but it's something that I think from a buyer's perspective you need to take a very close look at, because it really does enable you to maximize your profits and your ROI. We're going to show how your investment basis can be reduced at a rapid rate, which accelerates your returns. We're going to show you some charts and graphs about how we can help you accelerate those returns. The real estate under this model, and we're going to talk about the model in a few slides, but the real estate becomes secondary to the ROI model. And Brian Kaufman will be on here in a little bit, and he'll be speaking directly to that, how they sort of view the investment, their investment strategy when it comes to real estate. So stick with us throughout this PowerPoint presentation. We've got about 20 slides to go through. It's going to take me about 30 minutes to get through this. but we're going to be showing you some examples, and we're going to be showing you some strategies that you may consider implementing. Okay, these are sort of my 7 tips for making your next purchase your best purchase. Now, full disclaimer here, I got a lot of this from the hedge fund folks that I've worked with over the past 5-6 years. Many of you know that's where I've really spent most of my time is working with the larger fund buyers, and so most of this stuff is stuff that I've gleaned from them. So number one, you always want to buy below market value. That goes without saying. This is a market right now that you should never even consider buying something at or above market value. So you want to always look to buy below market value. You want to buy direct from the selling party. What does that mean? Many of you don't know this, but in many cases when you buy a property from a selling entity, in many cases that entity has bought it from somebody else and just flipping it to you. Or maybe they didn't even buy it. Maybe they're just doing a direct flip to double close. Or maybe they're an REO company that's buying property for 30 grand. They're just marking up to 45, 50. That's not uncommon, but you want to stay away from that. And there's ways to do that. We can talk to you about that. Don't buy anything that's not off market. And I think that kind of goes without saying. I think if you're looking on the MLS, you're just not going to get the best deal. Look for year-on-year appreciation as well as ROI. You want to look for both. In other words, you want to look for property that not only gives you a healthy yearly rate of return, cash on cash, but also in a market that's appreciating and going up in value. You can get both. You should look for both. Your infrastructure is critically important. I talk about this in almost all of our webinars. Today, obviously, we're featuring a group that's completely unique, not just because they have the ability to manage your property, but they have the ability to manage your investment. And there's a difference. Understand your strategy, short or long term. Every fund that I've ever worked with, the first thing that they do is they give you their criteria. You should do the same thing. You should know what you're looking to accomplish before you go into it. It makes it a lot easier, especially under the program that we're about to discuss, if you understand what you're trying to do up front. And only buy fully rehab or rent-ready properties. There's a lot of groups out there that will sell property that is not rehabbed yet, and there's danger in that. And the folks that I've experienced over the last 5 years that have had the least amount of success are people that bought property that wasn't rehabbed yet under the promise that somebody was going to rehab it for them. I can just tell you that that's a model that's had the least amount of success. So we always encourage folks to look at turnkey, cash-flowing properties, preferably with a tenant in place. But if not a tenant in place, at least the property should be fully rehabbed and rent-ready. We think 2016 to 2015 is and will be a great time to buy property. I just want to go through a couple of reasons why and a couple of changes that we've seen in the market in the last 12 months. First of all, a year ago, most of the hedge funds were still buying a lot of property. I mean, they were, whether it be Buy Property Direct or Havenbrook or Colony, Blackstone, Imitation Homes, those folks were all aggressively buying income property. And they have slowed down tremendously in 2015. And what the result of that is you have a lot of motivated sellers out there, and you're seeing prices stabilize. I mean, somebody said to me last week, they said, you know, it's interesting, you're seeing in a market that's going up, you're still seeing prices that are consistent with, you know, what we saw 2, 3, 4 years ago, and that's absolutely true. In a lot of cases, you can buy at or even less than what you were buying for several years ago, even though the market's appreciated. And a lot of that has to do with the fact there's more inventory out there. And some of the wholesalers that were out there, you know, buying property, renting them out, selling them to investors, there isn't as many buyers. So what does that do? You've got motivated sellers and you've got stabilized pricing. It's really become a buyer's market right now. You can get some great deals out there. The markets are now well-defined. What do I mean by that? Well, two things. First of all, the markets themselves, and we know now where the good markets are. I mean, we know where you get good rates of return, good appreciation, good inventory, all that sort of stuff. But it also means the market's defined with regards to the next bullet point, which is the real players have been defined now. I mean, we look at people like Diverse Property Management, Brian Kaufman's group. We look at what they're doing. We say, well, you know, sort of the cream has risen to the top. For most of us in this community, we understand now who the good guys are and who the bad guys are, where the good property management teams are, and where they're not. Where you're going to have challenges with your property managers, where you're going to have challenges with your properties. The markets are pretty well defined now. There isn't a lot of secrets out there right now with regards to where the best properties are at the best prices with the best property management teams. And as we talked about a lot, you know, if you may get the best property in the best market, but if you don't have the best property management team, your investment will be compromised. You need to have all three of those pieces put together, and in 2015 and 16, we're very clear now on who the players are, what markets you want to be in, et cetera. So the markets are defined, and those reliable providers of inventory have really emerged. You know, real estate being seen as a commodity is nothing new, But I think that a lot of people today would tell you that maybe now more than ever, it's really a good time to have at least a part of your portfolio in real estate. I'm not one of those alarmists that's going to say that the stock market's going to crash and the economy's going to go into the tank or the dollar's going to be devalued again. I mean, we hear those sorts of things, and maybe there's truth in that. But what we do know is that, yeah, the market probably is in need of correction. It's probably going to get one, whether it be large or small. And so having your money in paper stocks, there's some risk in that. And, most investors would tell you that the best place to put your money is into real estate, and we're still seeing that today. Financing is now available. A year ago we were doing these webinars, and we were saying that, in 2015, we're going to see financing become available again to the investor. And we did see that. The challenge was it was only in select markets. There was only some markets in. I think you're going to see that expanding in 2016. I think it's going to be a great time to look to buy real estate and then, use that real estate as leverage to then possibly go out and get money, get a lender to help you build that portfolio out. I think that's going to be much more common. And we've seen Blackstone already spin off a division called B2R Finance, and what they do is they provide financing for folks that have a portfolio of 5 and want to get to a portfolio of 25. And so you're seeing that money be made available. I only see that expanding in 2016. Finally, there's tax benefits, and we're going to talk about that today. We're going to talk about some of the things you can do to take better advantage of your particular investment. I just pulled this off a Realty Tracks a few days ago. This is just a quote by Darren Blomquist, and it plays into what we're going to be talking about today, which is just that this is not a flipper's market. This just goes on to say that he believes in 2016 this is going to be a better year for buy and hold investors than for flippers, and we happen to agree with that. You're actually seeing a lot less flipping going on. You're seeing a lot more people getting into this market for the purpose of buy and hold. And of course, you look at all the hedge funds. I mean, there's a good model to follow. 5 years ago, everybody thought, well, the hedge funds came into this party. They sort of crashed the party, actually. They came in, they bought a bunch of stock, they built these huge portfolios. The common thought was, well, then they're going to flip it. They're going to flip it, or they're going to let the market go up a bit, or they're going to sell out, or they're going to turn it into a commodity and trade it on the market. That's not what they were doing. What's interesting was they would always tell me when I have my interactions with them that their strategy was buy and hold. And it was interesting because nobody believed them. I mean, most people didn't believe them. They just thought, well, now that's not really true. Anyway, in 2016, what we know now, these hedge funds took were buying these properties to buy and hold. It was always their strategy. These are now cash flowing, performing portfolios. These guys are making nice returns on. We like using Warren Buffett's quotes because Warren, as many of you know, was famously quoted back in 2006 as saying it. He would buy millions of single-family homes, but he wasn't very handy. In other words, what he was saying was that I'd buy all these. The best investment in America today is to buy single-family homes, but it takes infrastructure. What we're talking about on today's webinar. And so, of course, what did Warren Buffett do? He went out and he purchased Prudential Realty. So he turned that into Berkshire Hathaway Home Services. And so now he's got his infrastructure in place. And so I always sort of troll the internet looking for what Warren's got to say about the current state of the real estate markets. I pulled these off last week. And one of the things he said that I really like is, today's market fluctuations are your friend because they've scared off the competition, other investors, and that's absolutely what we've seen happen. And they're also your friend because the fluctuations create a flood of motivated sellers. That's absolutely true. It's exactly what we're seeing right now. And as any savvy investor knows, buying from a motivated seller is the only way to make it in this business, and that's exactly what we're seeing now. When I was talking about the hedge funds leaving and the vacuum that leaves for the smaller investor, that's exactly what Warren Buffett's talking about there in that quote. And then his next one, of course, plays into what we're talking about, which is a buy and hold strategy, a model that's held for a longer period of time with a seasoned property management team providing excellent properties in an appreciating market. He goes on to say our favorite holding period is forever. And the translation, obviously, to build long-term wealth, you must buy and hold real estate. And you know what? That's a classic quote by him right there because it's so true. Really, the smart people in real estate aren't in and out of this. They buy the real estate below market value, they cash flow it, they turn it into an investment vehicle, and they ride it out because it's a great cash flow vehicle. It just produces cash for you every month in, month out. And then again, as we were talking about earlier, where do you put your money at these days? You put it in stocks, you put it in real estate. Naive people are putting their money into stocks. The smart people are still investing in real estate. Keep plenty of tools on hand because what worked in 2006 does not work today, and that's absolutely true. We see what we're going to be talking about today with diverse property management as being a serious paradigm shift in how you see investing in real estate. This is a blog that that I took off the internet just a couple of days ago. What it was a guy that owned some property down in Jacksonville. And I can send whoever wants the link to this, I can send you the whole link. I chopped it up. I only put a few paragraphs in there. It was quite long. But it talked about his experience in investing in Jacksonville. There's a couple things that just jumped out at me. The first thing he said was, he's been investing in that market for about 14 months. He's bought 24 properties. He could have bought a whole bunch more if he had the interest in scaling it, which means teaming up with somebody like a diverse property management team that has the ability to scale. He could scale it easily because he saw so many great deals out there. And then he went on to talk about the fact that he was using his 401k or a self-directed IRA, but he also said something that really stuck out at me. He said, he buys these in an LLC. And that's what we're going to be talking about today, too. And then what he said at the very end, which I think always key when you're an out-of-state investor, would I want to buy them in Jacksonville, Florida, if I live in Nevada? And so he went on to say, by the way, I don't live in Florida or anywhere near it, nor have I ever stepped foot in Florida. I have a series of LLCs that I use to syndicate my property purchases, and that's exactly what we're talking about today. This guy's name is Jeremy Payne. It was a great little piece. If anybody'd like to get a copy of it, I can certainly send you a copy of that. I always look for stuff like this when I'm profiling a market. I always look for, what groups are out there, sort of saying what's the best markets to buy in. And there's a lot of them. I looked at Forbes. I looked at CNN Money's sheet yesterday, and I pulled this one off. This is from JWB Real Estate Capital. And there's a number of factors that all these groups use to determine, where's the best place to buy, and there's a lot of factors that go into it. I mentioned some earlier, you want to get good property, you want to get good property management, and you want to have good infrastructure in place. But these are the ones that they use. A price-to-rent ratio, pretty common. If you're able to buy something at $40,000 or $50,000, you can rent it for $700 and above. That's always just a great cash flow return. So you're looking for cash flow opportunities. Number of Fortune 500 companies that are in that market, that's really an important one. I've had people say to me before, a lot of the funds, for example, would say, we like those markets where there's an NFL franchise. If there's an NFL franchise in that market, we like it. Why? There's an NFL team there. That means there's a good economy, good housing market, good job market. And, of course, the Jacksonville Jaguars, an excellent NFL franchise. Potential for home price appreciation. You obviously want to look at that. As I mentioned a little while ago, you want to look for both ROI. I mean, ROI is easy. We can show you on the tape, that it's renting for this, taxes is that, insurance is this, there's your ROI, that's your cash flow. But are you in a market that's going to appreciate? And so JWB Real Estate Capital came to the conclusion that Jacksonville, Florida was the #1 market to invest in. Now, I've got some slides coming up on Jacksonville, and I'm trying not to labor through those for too long. But to me, I've been saying this for a number of years now. If you want to know where the best markets to buy are, just go where the funds. Go where the funds are. What led us to Jacksonville? Many of you know us. They've been on our webinars. You see our email campaigns every day. You see that we get property all over the country. What brought us to Jacksonville? The funds were asking for it. I kept getting requests from funds looking for tapes in Jacksonville. That tells you that this is a good market to buy in. So JWB Capital says Jacksonville is a great place to buy. There's two interesting cities I saw in here that really stuck out to me. First of all, number 7, Detroit. That's interesting. Detroit, 5 years ago, no one touched the 10-foot pole. And then Atlanta, which interests me because Atlanta is rated number 10, and historically Jacksonville has been in the top 3. On almost everything you've read for the last 5 years, Atlanta has been in the top 3 markets for industrial real estate. Now, why isn't it anymore? Well, because you've got a lot of competition down there, and the cap rates aren't very good. If you get 6, 7, 8% cap rate in Atlanta, you're doing good. For example, in Atlanta, a $700 rental will cost you $60,000 to $80,000. In Jacksonville, a $700 rental will cost you $40,000 to $50,000. So you're seeing Atlanta sort of slide down that hole a little bit. All right, so let's talk about Jacksonville just for a couple slides. I'm going to do it just in an abbreviated fashion so we can talk more about Brian Kaufman's group and diverse property management. So let's just a couple slides on Jacksonville. But first, let's talk about diverse. Brian Kaufman, been in the business for 31 years, bought and sold over 1,000 property. He founded Diverse Property Management 3 years ago. Brian is a seasoned traditional cash flow investor with comprehensive and often exhaustive knowledge of all aspects of this business. Brian often consults for investors and syndication teams to create successful acquisition, hold, and disposition strategies. And as the owner of Diverse Property Management, Brian will be a key player, component in assisting you in some of the strategies that he's implemented that are completely unique. Again, I said this at the top, and I'm going to say it again right now. I talk to a lot of people in property management, obviously, because it's a key component when someone buys a piece of property. And so property management teams are folks that we interface with on a daily basis. And when Brian started to describe to us what he does for his clients, it was like that's like having a property manager and an asset manager under the same roof. And that's just, I can't tell you how unique that is. Brian uses an old-fashioned approach called math. His whole thing is about numbers. How do I drive this ROI up as high as I can? How can I have the lowest cost basis and have the best rates of return for not only himself but for his clients? It's a very unique combination. We're going to go through that in some detail. And I'm not going to spend I got a couple slides here on Jacksonville. Many of you know, if you Google Jacksonville, you'll see that Jacksonville is one of the top markets to invest in the country today. It's the largest city by population in the state of Florida. It's got a large military presence there. I didn't even notice, but it's actually the third largest military presence in the United States. Got a couple of Navy bases there, a submarine bases is based in Jacksonville. Significant factors in the economy include stuff like banking, insurance, healthcare, and golf, tourism. Tourism is a big deal in all the state of Florida, as most of you know, and it's a destination for golfers. I know a couple of guys actually go down to Jacksonville and go golfing. So it's got a strong economy there. As I said, this is just about the rate of appreciation of what you're seeing there and how you're seeing some of these counties grow in Jacksonville. And it's interesting because traditionally the Florida market, the investors that flock to the Florida market traditionally have been more in South Florida with some in Orlando, but Jacksonville was really not a place that you saw groups flocking towards, but the economy there is strong. It's an appreciating market. It's a market you can look to get a solid rate of appreciation in. And of course, you got some of the better property management teams clearly down in that market. So let's talk about them. Let's talk about diverse property management and what their model is. And this is a paradigm shift. For those who have seen me do these webinars in the past, I've had lots of property managers, and you guys all know that. But never have I had one that had an approach to the market like diverse property management does. And I've never actually think I've featured a property management company along with inventory. I don't think I've ever done that before. This is actually a first for us. But their model is plain and simple. It's all about ROI. It's about the math. The objective is to shelter the income and to lower the basis. The lower the basis, the higher the profit. It's simple math. Part of the success is reducing the basis through IRS rules of depreciation, utilizing this thing I mentioned earlier called cost segregation. Real estate is the vehicle. Cost segregation is an IRS tax code that gives you some benefits. Now, again, I got to give a disclaimer. I'm not a tax accountant. I'm not a tax preparer. You need to consult with your tax professional for tax advice. I'm going to illustrate some things that you may consider. I'm really going to encourage you to pick up the phone and call Brian Kaufman and talk to him. Brian will be on here to answer some questions here in a few minutes, but I would encourage you to call him and talk to him about this more in detail. This is a webinar for real estate investors, not speculators. If you're a speculator or you're a flipper, this is not for you. This is for the buy and hold investor that's looking to invest their money and get a strong rate of return for a long period of time. What Diverse does is they use the benefits of real estate, such as expense reduction, depreciation to their advantage. They use the IRS allowable deductions, property tax appeals, insurance changes, and strict Lean Six Sigma level cost controls to reduce the expense side of the business. Now, what does that mean? Lean Six, that's a really fancy term. It's a methodology to improve performance by systematically reducing waste. It's just a system to cut your costs down. We're going to talk about some of those specific costs there in a few minutes. The real estate becomes the vehicle used to deliver the NOI number. And in the Diverse model, the NOI is the primary concern, not the value of the real estate itself. Traditional criteria like comps and valuations and appraised values and all that stuff, which is what most people use, that's relevant when you're going to sell the property. So when you're focused on selling the property, that stuff becomes important. But for the moment, the focus is going to be on ROI. What does Diverse focus on? As the asset manager, they focus on the rental market, job stability, job growth, and expense control. That's what their focus is going to be on. So what's the model look like? What sets this model apart? Let's start with this. You got to buy at the right price. We said that in my 7 tips. The very first thing I said, you got to buy under market value. You got to get good inventory. And one thing that we also learned about Brian was that he's got excellent access to inventory. So if you're looking to scale your portfolio model, this is a great group to be in business with. They buy in high demand blue collar rental areas with at market or above rental opportunities. Let me explain that. Most people know or understand that if you're looking for high rates of return, you're not buying in an A or B market. I live in Orange County, California. If you buy a house in Orange County as an investment, you're going to spend, the median price probably $400,000. You're going to rent that out for about $2,000. $400,000 in a place like Jacksonville is going to buy you around 10 properties. It's going to net you probably 4 times more than what you're going to get in California. Now, some people say, yeah, but California is a more solid market. I don't think that's true at all. I think California slides around as much as any other market, but the point is your ROI is never going to be strong in that type of a market. In the blue-collar rental areas where they can rent at or above market value, that's where you're going to get your high rates of returns. Okay, then what they do is they begin expense controls, and what they will do is they will fight for property tax reductions. They'll lower the insurance costs, cut capital outlays, and will cut utility expenses. They'll cut it all. The whole idea is to cut those expenses down so that your ROI goes up. They do that with a lean Six Sigma approach to eliminate any and all variance that negatively impact your business. That's what their model is all about, is bringing up that ROI to benefit your bottom line. The income is not in their control. Obviously, you can only rent something for what you can rent it for. So the focus isn't so much on the income because they're going to rent it at or more than what the market value is. But even if you rent it for above market value, you're never going to rent any rental unit for way above market value in a blue-collar type market. So that's not their focus. Any potential fees are applied to the income side of the profit and loss. Expenses are addressed as outlined, and our expense reductions show their power. So the focus is going to be completely on what they can lower those costs from and how they can get you into that property at the best possible price. And I mentioned this at the top of the broadcast, but it's really relevant. Again, they will escrow the first 12 months ROI at closing. This model is so uniquely different from anything that we've seen out there. It's really a very unique model. I've never seen anybody say your first 12 months net operating income will be in escrow at close. That is completely unique to this market. I want to talk about cost segregation now. Now again, I got to put on I'm not an accountant hat, but I want to explain what it is and how they use it, and I'm going to show you a graph and a chart. And again, this webinar is meant to stimulate your desire to want to give us a call and say, hey, I want to learn more about this and how I can take better advantages of the tax benefits. I told this story on the first webinar. I had an author of a book about tax benefits on one of my radio broadcasts, and I was blown away at the amount of people that owned real estate that didn't understand the benefits of tax benefits. They just didn't even get it. I don't even know if a lot of people even spend any time looking into it, but there's really some things that can benefit you. Cost segregation is one of them. So let me explain what it is. It's an IRS-approved, commonly used strategic tax planning tool that allows companies and individuals who have constructed, purchased, expanded, or remodeled any kind of real estate to increase cash flow by accelerating depreciation deductions and deferring federal and state income taxes. That's what fundamentally it is. It involves the identification and reclassification of personal property assets from real property in order to shorten the depreciation time for taxation purposes and reduce current income tax obligations. Now, again, you want to talk to Brian about this, because he's the expert, but that's what cost segregation is, and that's how it can benefit you. Following IRS methods and protocol for cost segregation, there's a large tax savings premiums for valuing Section 1245. That's just of the IRS tax code. For personal property, it's highest possible. In addition, property taxes can be lowered, and short-lived personal property will devalue more rapidly than real estate and therefore generate less tax over its depreciable time. Now, the Wall Street Journal says about that, the U.S. Department of the Treasury states that cost segregation is a lucrative tax strategy that should be used in almost every major purchase of commercial real estate, and that is at the center and the core of what diverse property management does to the benefit of their clients and their buyers. And this is a graph and a chart that I'm not going to spend a lot of time on, but just an example. And again, we'd like to talk to you about this one-on-one and give you some real specific detail, but essentially this is just a comparison. Using cost segregation versus not using cost segregation in your model. And it's just using a purchase price of $50,000, a property of $50,000, which is a standard price. And just if you draw your attention down to the very last green line on each slide, you'll see that in years 5, you're looking at a 37% ROI by using cost segregation versus, if you're not using it, a 30.5% ROI. So the differences are significant, and when you blend that with the cost savings and the reductions in some of the things we talked about in the previous slide, you're talking about a much higher ROI. You're getting as much as you can on your rental side. You're reducing your cost down as far as you can. You're combining that with cost segregation, which allows you to earn the highest possible ROI on your property. We're going to talk about some properties now, and then we're going to get into questions. And I saw a couple questions that did come in, so we've got questions already in the queue. So I thank you for that. We'll answer those as soon as we get to Brian here in a few minutes, and we'll answer those questions. So we're going to talk about some properties now. Oops, went ahead of myself there. Okay, so this is just 4 examples of properties. Although we are featuring these properties today, we're going to give some discounts on these properties today. But these are the types of properties you'd be looking at. It's a $600 a month rental. You can see your property taxes, your insurance, your property management fee. Property management fee is at 9% of collective rent, if you're curious. Your cap rate, which is obviously an extremely strong cap rate. Anything you get in any market that exceeds 10%, that's a darn good cap rate. When you start getting in the 12s, 13s, 14s, 15s, you're talking about a really strong cap. In a market like Jacksonville, it's appreciating as it is. Cap rates like that, that's a winning combination. You see your NOI there, of course, that property, that NOI would be escrowed at closing. The first 12 months NOI is escrowed at closing. And then, of course, your sales price of $49,000. Just another example, this is $700 a month rental. You see your property taxes, your management fee, your insurance. Cap rate is 16.46% with an NOI of $6,500. And then, again, sales price is at $49,000. And then on another one, this is a $650 rental. You see your taxes, your insurance, your property management fees, your cap rate of 15.2, and your NOI is $6,000. Your sales price is $49,000. And just last example, and then we'll get into some questions. This is a $750 rental. Cap rate is 17.2. When you start seeing caps like that, by the way, folks, those are extreme. When we first started doing webinars back in 2009, the goal that everybody shot for was 12%. So here we are, 6 years later, and you're seeing caps at 17 in a market that's still going up. You're still buying below market value. In a market like Jacksonville, one of the top markets in the country, you're still below market value. Your values are appreciating, and you got smoking cap rates at 17% on a property like that. NOI is almost $7,000. Your sales price is $49,000. Now, what we did was, and if you're on my mailing list, this is going out to all my mailing lists tonight, which is going to be for this webinar, along with the YouTube video from today's webinar, which will be included with this. We're going to special these 4 properties at $160,000. So it's a nice solid discount on those, on all those 4 together. So $160,000 gets you all 4. Your gross rents are $2,700 a month. You got a $24,000 NOI on that. You got a solid NOI at 15%. There's no repairs to be done in these. They've all been rehabbed. They're all rehabbed. They're rented. They're professionally managed, obviously, by Diverse Property Management. This requires a signed management contract with the seller's property management firm. So if you're going to buy these, you have to use the property management team that's in place. By the way, you always want to do that anyway, because one of the biggest hiccups you get when you buy investment properties, if you buy investment property and you've got somebody who's managing the property, and then you take it to another property management company because somebody told you that was a good idea, that will always be a bad idea. Because if the tenant was placed by that property manager, there's a relationship and a rapport there and a trust there. As soon as you switch, you run into problems anyway. So that's a blessing that they're saying it's required that you sign our property management agreement. They do require a 2-house minimum package, and the transaction is to be done as an LLC level transfer. Now that's important. I'm going to let Brian speak to that here in a few minutes. But it's important to know that that's sort of the strategy here is to acquire these properties under an LLC level transfer, and there's reasons for that Brian can explain. That, again, is very unique. I haven't seen anybody that's approached this from that strategy, but there's good reasons why they do that, and it's beneficial to you, to your bottom line, and to your long-term profitability in investing in that property. I'm going to leave these numbers up here for the duration of the questions that we're about to field. So if you want to give us a call, you can give us a call. I'm not going to give Brian's number out. Teresa and I, if you don't know Teresa Jackson, Teresa's a real estate consultant, worked with Teresa for over 10 years. She, as well, has been a guest on my radio show. She is working with us on this project. She will be, as well, taking your phone call, so feel free to take down Teresa's phone number. We had some technical difficulties this morning, so what we're going to do is I'm going to ask a few of the questions that we had this morning for Brian to answer. We had some audio problems, and so when we recorded it, it just didn't come out sounding very professional with some crackling and whatnot throughout the questions and answers. So we're gonna ask a couple of those again, And I'm just looking in my queue here for some questions. Okay, let's get to a couple of these questions, then we'll get to some others. Okay, Brian, you want to open up your mic? Folks, meet Brian Kaufman. He's going to be your new best friend. He's one of the better operators in Jacksonville, Florida, and he's got a completely unique strategy into how to approach the real estate market. So you're going to get some really good information from Brian now. So Brian, thanks so much for being on here.
Thank you, Charlie, for the introduction, and welcome to sunny and warm Jacksonville, Florida.
Yes, and your audio is much better. I know mine is too. Okay, so Brian, I'm going to ask a couple of questions. I'm going to get to the ones that are in the queue from the listener, the people we have on right now. But I want to get to a couple of these other ones that we had from this morning. First of all, talk about how you are able to lower property taxes, insurance, and utilities.
Well, each one of those is a different strategy. I'll take property tax because Florida is unique in that. The other ones are pretty much, the real estate management 101. We fight everything. So on the property tax in Florida, and one of the ways we're able to guarantee an NOI is we file a lawsuit against the city and the appraisal department for the adjustment. So we buy a significant amount of properties in Jacksonville. So say on Main Street, we own 27 properties. So if you're going down through there with your property appraiser, very unlikely that the people that are going against the appraisal own 27 houses on the same street, but we do. So we use that leverage as part of our negotiation tool when we go to the appraisal department and we say, listen, I know exactly what it's worth. I own everything on the right-hand side of the street, so that's what they're worth. And we win. So out of the several hundred lawsuits filed to date, our rate of success is in excess of 97%. What that means for us in Florida is that you have a 2-year lock on the tax. So when you win the lawsuit, you win the year that you're fighting for, and you win next year. So it locks in one of the largest expenses against the single-family portfolio.
Yeah, I've never heard anybody implement that strategy, Brian. Okay, next question. Okay, I'll go to this one. How are you able to escrow the first 12 months net operating income at closing, and are the distributions paid out monthly or quarterly?
What we do is we open when the LLC is created or moved, we have 2 accounts. We have an operating account, we have a capital account. We would put the NOI into the capital account, and that would be drawn down based upon the months that go by. So the property's already tenanted and cash flowing, so we know what the NOI is going to be month over month. That distribution, depending on whether it's a individual or a self-directed IRA or the situation, we would distribute quarterly, semi-annually, or annually. Every month an owner's report goes out, so you see the basic financials, you see a P&L, balance sheet, cash flow statement. You'll also get an executive summary, anything that we see that may be going on in the market. So you have a kind of a heads up month over month what's happening.
Okay. Brian, do you do any multifamily in Jacksonville? Duplexes, triplexes, anything like that?
We do. I mean, over the years I've picked up a lot of stuff. I have a couple of decent sized multis. I have 4s, I have 2s, I have 3s, all in Jacksonville. I have a 112 unit complex in Jacksonville. If I had my druthers, if I had my way, I'd sell all the multis. I mean, the 112 units under contract right now, so that money will be redeployed in the single-family portfolio. There's just no place to make a better rate of return.
Early in the presentation, Brian, I made a statement that the real estate becomes secondary to the ROI model. Can you just kind of comment on that and as to why?
Well, I mean, if you're looking at an investment, and when I was running as asset manager for a $100 million blind pool REIT, the conversations and the people I talked to always wanted to spin the conversation into Wall Street vernacular. They wanted to use those terms, basis and yield and dividend. So I've kind of transitioned into that mode. I can't get out of it. So if you're buying a stock like Walmart, you don't go out to Walmart and do a retail analysis and see what's on the shelf and who the employees are, what the benefits package looks like. You look at the numbers on the stock itself. You look at the dividends. You look at the financials. You look at the technicals that work that stock. The Walmart store doesn't really matter. And that's kind of what we're saying here. Take the focus off of the real estate. The real estate still exists, and it's all cool, and it's appreciating and all that stuff, and it's in Florida, so you don't have to worry about it freezing up like Detroit or some of the other cities that were on the list. You don't have to worry about those things. The high tax rates, our tax rates are zilch compared to Detroit. So if you're looking at those things, you break it down to the technicals. So we look at the NOI, what we can get on market rent, expense as much as we possibly can. Everything that we can reduce, we reduce, jacking your NOI overall. That NOI creates a valuation. If you use the three approaches to an appraisal, you've got comps, income, and build cost. So build cost we've got nailed because nobody ever really uses it anymore because it's so high. Income, if you get a $6,000 NOI as in these sample houses that we put on the webinar today, a $6,000 NOI at a 10 cap, the house is worth 60. Charlie beat me up to the point where I'm selling it for 40. So you're getting a $60,000 asset for 40,000. Now I'm not great at math, but that's a $20,000 profit.
Yeah, you're walking in with a lot of equity, aren't you?
You are, and I don't know how I let you beat me up on that, Charlie, but you did. So
I think Teresa did it. I want to blame it on Teresa.
All right, thank you. So, so kind of looking, everything's based on math. So the house itself is a vehicle that we use to create a rental income. That rental income we manage to the utmost, get the most out of it, and we've got it now an income stream that's worth money. So the golden goose, the real estate, creates the egg, the income that we want. So we don't want to kill the goose. We want to keep the goose alive and healthy, but what we're really after is those golden eggs.
Explain the benefits of making this an LLC transfer, Brian. What's the benefit to that for the investor?
First and foremost, I think for most of the people out there, Florida is a non-income tax state. So an LLC in Florida is a really nice thing to have. That's one of the reasons that attracted me down here besides the beautiful weather. So the LLC level transfer moves everything over without closing costs, without additional fees, without additional headaches. The income benefits of being in Florida are nice. If your accountant, your business is set up that you could use that for additional advantages that you could have with a Florida LLC. As a flow-through entity, it's very simple. The management agreement that we have with Diverse Property Management, they do the income tax filing, so you get a K-1. It's all wrapped up in a nice turnkey package that you don't have to spend a lot of time on. If you want to, that's great. You could add additional assets, you could add additional business expenses or flows through there. You could do whatever you want. That's up to you. But the LLC in Florida is a real nice place to do business.
Is the closing process similar, Brian? For example, I mean, is a warranty deed provided where they can ensure there's no liens or encumbrances against the property?
There is. There's the properties that have been put into the LLCs, they're warranty deeded over, title insurance is done, and we don't have to redo it with an LLC transfer. Basically, the easiest, quickest, least expensive way to transfer, LLC transfer, simple stock purchase where the prior owners are cashed out, new owners are brought in, and it's a stock transfer. Very simple. So with that process, there's no closing costs associated with it because there's no real estate movement. The real estate stays right where it is. Now, the 12-month NOI guarantee is what substantially relieves any heartburn with that transfer. If there's any bills or whatever else that are left one way or another, it's going to wash out in the first year. And anything that happens, your NOI is guaranteed. So it makes the due diligence process and the assumption very, very simple.
Next question. I have a self-directed IRA. How does cost segregation analysis work since I'm not currently old enough to take a distribution?
Yeah, well, you're not concerned with the distribution, Charlie. What you're concerned with is the ability to redeploy capital. So if I'm a 20-something, which I wish I was and know what I know now, if I'm a 20-something and I've got $50,000 going out in my self-directed IRA, what I want to do is get part of that capital back to redeploy. So with cost segregation analysis, I'm pulling that capital back at a faster rate than if I can pull my capital back on a 7-year versus depreciate on a 27.5-year and pull my capital back. 7's way quicker than 27. After 5 years, if you look at the chart that's in the webinar, after 5 years, it's a 7% spread or $3,600 a year. So I've already pulled through tax structure an extra $3,600 back that I can redeploy way earlier than waiting 27 years.
Right.
So the quicker I can get the capital back out there to work, the more I can do.
Next question, Brian. What do you see in the short and long term for the real estate market in Jacksonville? You see it continue to appreciate?
Well, I guess all of us want to know that, right? If we knew what was going to happen in the future, we'd all be sitting on a yacht somewhere. But I think in the short term, Jacksonville got beat up. Jacksonville got beat up like Las Vegas and not so bad as Detroit, but when the 07 bubble burst, there was a lot of expansion in place in Jacksonville because they were flying high. The bubble burst, you see a big hit in the real estate, and a lot of stuff went underwater. Then the Base Reallocation Commission hit Jacksonville with a 5-ship loss. So they pulled 5 ships out of the naval port Mayport and moved them to Virginia. Now they're moving everything back and more because Jacksonville is going to be the deepest port on the East Coast, the biggest shipping port on the East Coast. And in the 3 years I've been here, it's amazing what has happened at Talleyrand Terminal and the Jacksport. It's unbelievable. So I see ships when I first came here, containerized cargo ships from overseas come in. They're probably 3 or 4 stories of containers high. I saw one the last week it's 24 stories high. It's massive. And then this week, the U.S. Navy decided to bring in their new ships, the Littorals, Littoral, which is the ugliest ship I've ever seen. They're putting 6 of those in Mayport, effective immediately, and they're creating the only repair facility for those ships in Mayport. So in this year alone, just on the naval side at Mayport, they brought 7,300 jobs to Jacksonville.
I mean, I'm assuming you rent to a cross-reference. Do you get military-type tenants?
We do. We have military tenants, but it also pushes the tenant base around the city. When you bring in 7,300 jobs to a fixed point, everything moves around. So if you're in the blue-collar side, the real estate, the retail businesses, the restaurant, all of those people are also coming in looking for housing. Now, the government, in their infinite wisdom, through the Reallocation Commission, destroyed all base housing when the people were pulled out. So these people got no place to live. They got to go outside. So it's just amazing what it does, and it just creates a ripple all the way across the rental market, and it also is driving up price because supply and demand curve is bent. The demand is coming in faster than supply can be rebuilt. Now, on the other side of that, I mean, Jacksonville's got a lot of apartments, A-plus apartments. They're building them fast and furious, but a guy in the Navy is not going to afford a $2,500 a month rental payment. It's not going to happen.
I just got another question in, Brian. I got another question here. These properties seem to be in slum or very low-income areas. How do you expect there will be any growth when only investors are the purchasers? So are these all rental neighborhoods, or are there some homeowners in these neighborhoods?
There's a lot of home ownership, and a matter of fact, a lot of times we will structure the ability for people that rent from us to also buy from us. So we have a lot of homes that we hold mortgages on and we hold paper on that that we have 10, 15-year notes on. So there's a lot of transfer from rental to home ownership, and a lot of the investors that are now moving to that model. It's a longer commitment for the investor. You're now into a 15-year hold instead of a 5 or 10-year hold, but it's still the monies are there to make that work. So a lot of owner finance home ownership, and a lot of people moving in with either a HELOC and buying their kids a house or something like that too. So a lot of the properties are getting gobbled up fast. And as you know, I don't like using the word slum area. I mean, when you get something that's beat up, and you've got, when I first came here, there were streets with 50, 60, 70 vacant houses on the street. Now there's 4. So the investors, even though it's an investor-based buy on a lot of these streets and a rent, the overall demographic goes up accordingly.
Yeah, the whole neighborhood begins to improve.
I mean, I've got streets, Charlie, in Jacksonville. I own every house on the street. So am I concerned about what happens on that street? You betcha I am. I've got a lot of money deployed there. Is it going to go anywhere? No, it's not going to go anywhere. And I'm concerned about every tenant we move in or every house that we sell. So it makes a big difference. And it puts a level of control on those assets that you're not going to get with, maybe an individual homeowner that's strapped. We're not strapped. If a roof goes bad, we put a new roof on. If an AC goes bad, we put a new AC in. So we don't have the degrading of an asset. We bring the whole neighborhood up.
And I would assume that when you rehab those houses, you can provide a scope of work to the investor to say, this is what we put into this property to bring it into rent-ready condition, correct?
Well, on our buy side, we're very aggressive on the buy side. We don't buy anything without a budget in place. So if we have a property that's not been occupied, we'll buy it. We'll have a construction budget already in place. So I know exactly what the capital deployment plan is going to be. If it's a rehab or something that we purchase and whatever, the tenant's leaving or the owner's been moved someplace else, we'll have a budget in place to do an upgrade or whatever the case may be.
Okay. Folks, that's the last question I see in the queue. I'm going to hang around another minute or two here. We're at 2:55. This webinar will terminate at 3, so I will hang around here for a few more minutes and see if anybody else has a question. We've left let me get rid out of this now. We have left our phone numbers up here for quite a while and our email addresses. So if you want to call myself or Teresa, we'd love to talk to you. We'll be doing 4 more of these next week. And you'll also see these same 4 properties on our email campaign starting tonight if they haven't already been sold by then. So Brian, thanks so much for being here. And Teresa, thanks for being here as well. And we'll look forward to talking to all you. Again, you got our phone numbers. We look forward to talking to you. And again, we got 4 more of these next week, so be on the lookout for that. And more than anything else, if you're interested in this type of model, I'd really encourage you to contact myself or Teresa, get on the phone with Brian, and continue the conversation about how he can assist you in, maximizing your profitability on your next investment property. So with that, I want to say thanks everybody for being on. We had a really good group on today. I want to say thank you for that. And Brian, thank you to you for being here.
You're very welcome, Charlie, and I'll be talking to you soon.
That sounds good, everybody. And again, Love to talk to you. We've got a lot of people still hanging around, so if you got questions, I'll hang here for another minute. If not, have a great day, and we'll talk to you real soon. Okay. Okay, that's it. That is no more questions. I will officially say good afternoon, everybody. Thanks for being on with us today. We'll look forward to talking to you soon.